The broken bucket. Most people approach investing like they refeeding coins into a slot machine, hoping for a jackpot while ignoring the massive holes in their financial bucket. It is common to see investors chasing the next hot stock or cryptocurrency while carrying credit card debt at 22% interest. The core concept. Building a foundation. Building wealth is like building a house. You cannot start with fancy light fixtures. If your foundation is cracked and the roof is leaking, there is an optimal order for your money that maximizes returns, minimizes risk, and can save you tens of thousands of dollars over your lifetime. Step 1. The psychological safety net. The emergency fund. Before you invest a single dollar, you must establish an emergency fund. This isn't just for car repairs. It's a psychological safety net that prevents you from selling investments at the worst possible time or racking up high-interest debt when life throws a curve. The milestones. The first $1,000. Save this as quickly as possible to cover minor emergencies. The $2,000 mark. Research shows that having just $2,000 in savings boosts financial well-being scores by 21%. The largest boost of any financial factor. The 3 to 6 month goal. Eventually, aim for 3 to 6 months of living expenses, depending on your job stability. Step 2. Killing financial cancer. High interest debt. Once your basic emergency fund is set, you must eliminate all debt with interest rates higher than 8%. Credit card debt, often charging over 22%, is essentially financial cancer. The guaranteed return. Paying off a 22% interest debt provides a guaranteed 22% return, which is significantly higher than what you can expect from the stock market. The strategy. Use the debt avalanche method. List your debts and throw every extra dollar at the one with the highest interest rate first to save the most money mathematically. Step 3. The only free lunch. The employer match. There is one major exception to paying off debt first. The employer match. If your company matches your retirement contributions, you should contribute enough to get the full match immediately. 100% return. A 1-to-1 match is a guaranteed 100% return on your money. The strategy. Contribute only up to the match limit, then redirect any remaining funds back to your high-interest debts until it is gone. Step 4. The tax optimization zone. IRA versus 401k. Once your high-interest debt is gone and you've secured your match, move to an individual retirement account IRA. Why IRAs first? Employer 401k plans often have limited, expensive mutual funds with fees that eat your returns, like termites in a wooden house. IRAs offer more control and lower-cost index funds. 2025 limits. You can contribute up to $7,000, $8,000 if over 50. Growth versus traditional. Roth. Pay taxes now. Withdrawals are tax-free. Best if you're early in your career and in a low tax bracket. Traditional. Deduct contributions now. Pay taxes later. Best for high earners in their peak income years. Step 5. The secret weapon. The health savings account. The HSA is perhaps the most underutilized investment vehicle in America. Acting as a Swiss Army knife of tax advantages, it offers a triple tax benefit. Tax deduction on contributions, tax-free growth, and tax-free withdrawals for medical expenses. Long-term strategy. If you can afford to pay medical bills out of pocket, let the HSA money compound. After age 65, it functions like a traditional IRA for non-medical expenses, but remains tax-free for healthcare. Potential. Maxing this out for 30 years at a 7% return could result in over $400,000 in tax-free wealth. Step 6. The final frontier. Maxing out in taxable accounts after the age. Go back and max out your 401k. The 2025 limit is $23,500. Only after maximizing all tax-advantaged accounts should you move to taxable investment accounts. The danger of tax drag. In a taxable account, every dividend and sale is taxed. This tax drag can cost you nearly $250,000 over 30 years compared to a tax-advantaged account. The benefit? Use taxable accounts for flexibility like early retirement or a house down payment since there are no withdrawal age restrictions. Conclusion. Following this sequence: emergency fund, debt, match, IRA, HSA, Max 400, Uno mil. Then taxable ensures you aren't building your wealth on quicksand. Do the boring foundational work today, and your future self will thank you.